This presentation introduces GDX, the VanEck Gold Miners ETF, as a way to gain exposure to the global gold mining industry through equities rather than physical gold. The fund offers investors access to major mining companies across several countries, making it a focused but diversified industry vehicle. In this presentation, we will look at GDX's structure, major holdings, country exposure, and the key risks that influence its performance. The main point to remember is that GDX is not simply a gold price proxy. Its returns are tied to how mining businesses perform operationally, financially, and geographically. That makes it useful for investors seeking sector exposure, but it also requires a deeper understanding of company-level and geopolitical drivers. GDX is a long-established ETF with the ticker GDX and an inception date of May 16, 2006. As of March 5, 2026, it manages about $32.22 billion in net assets, charges a 0.51% management fee, holds 53 companies, and is listed on NYSE Arca. Its top 10 holdings account for about 56.7% of the total portfolio, which shows that while the fund holds many stocks, a large share is concentrated in a relatively small group of major miners. The largest positions are Agnico Eagle Mines, Newmont, and Barrick Mining. This slide highlights that GDX is both sizable and liquid, but not broadly equal-weighted. Portfolio concentration is an important feature investors should keep in mind. GDX is best understood as a pure gold mining equity vehicle. It invests in the stocks of large mining companies rather than in physical bullion. That means performance depends not only on the gold price, but also on mining costs, production quality, reserves, and management execution. Another key characteristic is its very high exposure to the materials sector, at roughly 99.97% as of February 28, 2026. This makes GDX a highly specialized fund rather than a broad market ETF. The top 10 holdings again represent about 56.7% of the portfolio, reinforcing that a few major names carry substantial influence. Investors using GDX should therefore view it as a concentrated sector bet with operational and geopolitical sensitivities, not as a simple substitute for owning gold itself. This slide focuses on the top 10 company weights in GDX. Agnico Eagle Mines is the largest holding at 9.82%, followed by Newmont at 8.63% and Barrick Mining at 6.36%. Other important names include Wheaton Precious Metals, Anglo Gold Ashanti, Franco-Nevada, Gold Fields, Kinross Gold, Pan American Silver, and Northern Star Resources. Together, these 10 companies make up 56.7% of the portfolio. That level of concentration means the fund's returns are heavily influenced by the performance of its largest miners. While GDX still offers diversification across many companies, it is clearly tilted toward industry leaders. For investors, this concentration can be beneficial when large-cap miners perform well, but it can also increase risk if a few major holdings face operational setbacks or market pressure. GDX's geographical exposure is also concentrated. Canada dominates the portfolio at 48.72%, making it by far the largest country allocation. The United States follows at 19.77%, while Australia, South Africa, Brazil, and Mexico make up smaller but still meaningful shares. This country mix shows that GDX is global, but not evenly distributed. It leans strongly toward Canadian mining exposure, which reflects where many large listed gold miners are headquartered or operate. Geographic concentration matters because country-level issues such as regulation, taxation, labor conditions, and political stability can affect company results. So, in addition to analyzing gold prices and company fundamentals, investors also need to consider regional exposure. Canada's dominance is one of the fund's defining structural features. One of the most important messages in this presentation is that GDX carries risks beyond gold price volatility. Because it holds mining companies, its returns are shaped by business-specific factors such as cost inflation, reserve quality, production efficiency, and operational execution. Rising energy, labor, and material costs can directly pressure margins. Geopolitical exposure is another major factor, since miners often operate across multiple jurisdictions with different regulatory and political conditions. Finally, concentration in top holdings means that a few major companies can significantly influence overall fund performance. In other words, GDX is not just a play on bullion prices. It is an investment in a group of complex businesses whose value depends on how well they can find, develop, and operate mines profitably in challenging environments. This slide gives a closer look at the major holdings, especially Agnico Eagle Mines and Newmont. Agnico Eagle is the largest position in the fund and is supported by flagship mines such as Detour Lake and Canadian Malartic, with reported gold reserves of 55.4 million ounces. Newmont, the second-largest holding, includes the Lihir mine and reported reserves of 118.2 million ounces. These examples help explain why these companies carry such large weights in GDX. They combine scale, recognized assets, and significant reserve bases. The broader top 10 list also shows how GDX is built around the leading names in the global mining industry. A useful caution noted here is that many companies have not publicly disclosed clear 2030 production guidance, which limits long-term comparability. This slide highlights the data limitations behind analyzing GDX and its holdings. Obtaining simple, comprehensive gold-equivalent reserve data is difficult, especially when companies report metals differently or operate across multiple commodities. Long-term production forecasts, particularly for 2030, are often incomplete or unavailable. There are also challenges in comparing developers, royalty companies, streamers, and traditional miners on a like-for-like basis. Because of these gaps, investors and analysts must rely on a combination of sources rather than a single perfect dataset. Key sources include VanEck's GDX Holdings Report and Fact Sheet, supplemented by reserve updates and company disclosures from major miners such as Agnico Eagle. The main takeaway is that GDX analysis is informative, but it should always be interpreted with awareness of the underlying data constraints. The key takeaways are clear. First, GDX provides global equity exposure to large and liquid gold mining companies. Second, diversification exists, but it is concentrated. The top 10 holdings account for about 56.7% of the portfolio. Third, the geographic mix is also uneven, with Canada representing the largest share by a wide margin. Fourth, investors in GDX are taking on company and geopolitical risk in addition to gold price risk. Finally, GDX is a pure mining vehicle, meaning it offers stock market exposure to gold miners rather than direct ownership of physical gold. Overall, GDX can be an efficient tool for investors seeking gold mining exposure, but it should be approached as a concentrated sector investment with both opportunities and meaningful operational risks. In summary, GDX offers concentrated exposure to major global gold mining companies and can serve as a practical vehicle for investors who want access to the sector through equities. Its strengths include liquidity, scale, and access to leading miners such as Agnico Eagle, Newmont, and Barrick. At the same time, the fund is shaped by two major forms of concentration: company concentration and geographic concentration. Performance depends on more than the gold price, including reserve quality, production execution, cost control, and geopolitical conditions. So the main conclusion is that GDX is a specialized investment tool, not a passive substitute for bullion. It can be attractive for targeted sector exposure, but it requires investors to understand mining-specific risks. This provides a good foundation for discussion and questions.